You're listening to Talking Law, the podcast where business owners just like you discover how to avoid legal landmines and build value using smart legal tips.
Hi, it's Joanna Oakey here and welcome back to Talking Law, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. Now, today we are at part 2 in our 2-part series, all about the top tips in business structuring for dentists and medical professionals. And of course, we have on board to talk us through this area, Stephen Guthrie from Prosperity Advisors. Now, Stephen has more than 20 years experience providing strategic business advice and taxation services to his clients. He is a director in the Business Services and Taxation Division in Prosperity's Sydney office, and he also leads Prosperity's health advisory practice and specialises in providing advice to medical and allied health professionals and their practices. So today, of course, we round off this 2-part series. We get deep into the business structuring tips for dentists and medical professionals. And even though we're talking specifically about dentists and medical professions, this episode and part 1 in this 2-part series, which you should go back and have a listen to if you haven't already listened to it, is really just as relevant for any business owner who wants to be across and to understand structuring within their business. It can be a bit of a thorny topic. It can be one of those areas that we see business owners just have their eyes glaze over when they're talking about, as Steve and I discuss. But it really is one of those areas that can make a massive difference, not just to how you can deal with income and asset protection during the life of your business, but also that really important question about taxation at exit. So we covered some of those initial elements in part 1, and in part 2, we're getting deeper into investment structures and options for premises ownership. So here we go. All right, so let's talk about some common practice structures and which might be appropriate for each different type of business or practice. All right, so let's start with companies, perhaps. Why are companies attractive? When are they best used? When are they best not used?
Sure. Companies are very attractive because of the corporate tax rate, which in Australia has been dropping and will still drop further over the next few years. So companies currently paying 27.5% tax, and that'll drop down to 25% if there are, aren't many medical professionals turning over the kind of income that keeps them at the 30% tax rate. Having said that, though, it's really important to understand that unless the profits stay forever inside the company, they're going to emerge at some point by way of a distribution to the owners, at which point there will still be tax to pay on that distribution. So
Yes.
the lower corporate tax rate is really just a deferral process until the profits emerge to individual's hands. So that can be really attractive in instances where, use an example, I've got a collection of allied health professionals who've come together and set up a business. They had a reasonably high startup debt to fund the fit out and to fund acquisition of the practice. So if they set up in a company, which is what we ended up doing for them, they didn't have any personal services income issues, so we didn't have to worry about that. They were going to be able to pay tax in the company at 27.5%. That would leave them 72.5% of the net profit left over inside the structure, out of which to pay back their bank debt, compared to running through a trust structure where all the profits get taxed to the individuals and all that's left is, after they've paid the 47% personal tax rate, they've got less after-tax money left over to pay back their bank debt. So companies can be quite useful as a mechanism to fast track your debt repayments. Obviously, at some point, that doesn't, you've reached the point where you've paid off your debt, at which point you're probably looking to extract some of that money. It will come out as a dividend and there'll be top-up tax to pay potentially. So, I guess that's why companies tend to be attractive. They pay tax in their own right. You don't pay tax on the profits at a shareholder level until the money comes out. The flip side, of course, is that companies are highly regulated. And if you've got an owner who thinks of the company money as their own money and they keep on dipping their hand into the company bank account and taking money out, then that's going to give rise to a loan account which may need to be managed. There's a provisions called Division 7A, which deal with shareholder loans. Companies tend to be a bit more regulated and need to be well managed in order to actually get any of the benefit of the lower tax rate. So flip side to lower tax rate is perhaps higher regulation.
And higher regulation and perhaps at points being used appropriately, as you were talking about before.
Yeah.
If the income is all coming from one source or whatever. Sole traders, then what? It's interesting that there is still quite a few professionals using this approach, but maybe give us your ideas on it.
So quite often at the start of their journey as a practitioner, whether it's a medical or a dental, an individual will start out as a sole trader. They move out of kind of a salaried role and might take up private practice rights, start doing some billing in private practice. Look, a sole trader kind of arrangement where they're just taxed in their own name is quite a legitimate first port of call for them. At the other end of the spectrum, a surgeon who's been in practice for 20 years may well also be a sole trader. The issue for specialists tends to be that all their income is generated off their own activity. They can't say, well, I've employed someone else to do my role as well. So quite often, quite high-earning medical professionals like surgeons and ophthalmologists and prosthodontists and kind of other variations thereof may have a significant. They may stay as a sole trader simply because the tax system doesn't allow them to hive off a share of their income to someone else in the family, as it were. Which is where you get to the service trust or other kind of structuring opportunities that might exist for those people.
And let's talk about that then. So how is it that you use the service entities in that way to alleviate those issues?
Yeah, so I'm old enough and grey enough to have been around in the glory days of service trusts. When people used to set up a service trust, employ all the staff and pay for all the premises and then put a 40 or 50% markup on those costs and use that as a mechanism to kind of charge themselves a fee for what was otherwise just kind of market-based costs that they were incurring and cut away a share of the income and pay that off to the family. ATO obviously came down on that quite a long time ago in terms of saying, well, if you're going to have a service vehicle, we're going to restrict the level of markup that you can apply to the costs that are being incurred. And that's quite, that's 10% or less. It's certainly not in the glory days of the 40 and 50% kind of realm. But having said that, there's still a place for service entities, and quite often some groups of professionals practice as collectives, so like radiologists, often where there's a significant expenditure on equipment which is shared. So they come together and they buy the expensive radiology machine or whatever it is. And in those arrangements, you quite often find that a fee is being paid across to a commonly owned entity which owns the equipment. And that fee is probably higher than what they would be able to extract were they just an individual running their own little service entity with their wife employed or their husband employed as a practice manager. So looking at opportunities to use service structures, they're still there, but it's not just a case of we're going to set up a sister entity and rip out a whole lot of profit without reference to any of the rules that now exist around use of service structures.
Yeah. All right. And so then if we're looking at trusts, so we've looked at companies, sole traders, obviously the next area is trusts. And in trusts, we have family trusts or unit trusts. And I guess just as the quick overview, I'm sure many, I don't know, trusts are often, I must say, this sort of structure that feels a little bit mystical sometimes when I'm talking to clients. They have not ever and, I must say actually to a lot of lawyers, they seem a little bit mystical as well. So an interesting, they can be interesting. So family trusts, I guess we're talking here about trusts that have a far more discretionary component, and unit trusts which is the type of trust that we would use where there's third-party relationships generally. Is that right? Is that the way you look at them and deal with them?
Yeah, so family trusts, I always think of trying to explain trust. They're a bit like a funnel. So the trust is an entity which a separate legal entity. It carries on. It can carry on business, own assets, do anything an individual can do or a company can do. It's just at the end of the day, end of each year, whatever income has been earned by the trust is almost invariably allocated by the trustees to this group of people called the beneficiaries. And they're the ones to whom the profit is allocated and who will pay the tax on that income. And so the trust is a family trust is a really good kind of vehicle within a single family group.
That's the name family.
It's a discretionary trust, a family trust, but they don't work tax effectively for unrelated parties.
Yeah.
Unit trusts are somewhere between the family trust and the company, kind of in the spectrum of structures. They have a lot of the flexibility of trusts, but they have equitable interests in them, so that they have units which can be held by either individuals or perhaps family trusts.
And this is where, and then when we start talking about, trusts, holding trusts, of course, that's when clients just start to get a little bit more confused. But that's why we have structure diagrams.
That's right. That's where their eyes glaze over.
That's right. Exactly. We can hear it happening right now. But I guess we've talked, in the beginning of this show, all about why family trusts can be problematic. So, and maybe if you can just give us a quick snapshot about some things to look out for, some things that could potentially be problematic in unit trust.
Yeah, unit trust. So think of a client, a bunch of specialists who've come together and set up a day hospital. And caveat, we weren't involved in the establishment of the structure. So significant level of debt, significant level of expenditure within the unit trust to set up this day hospital, and all of that went well. The unit trust was owned by one of these structures where the unit trusts are owned by the family trusts of each of the medical professionals. The problem has been that because of the nature of being a startup activity, the unit trust is both incurring significant interest cost as a result of its debt to set up the day hospital, but it also has significant depreciation deductions on the expenditure. And at the moment, in its startup phase, it's not making a profit. In fact, it's making significant losses. Those losses are trapped within the unit trust. Trusts can't distribute losses to their beneficiaries. And so in this circumstance, we have a bunch of high-earning medical professionals who own an interest in a structure which has multi-million-dollar losses in it, which they can't get access to.
That's a great story. I love that.
Had that been thought about better in the planning process, there would have been other steps that could have been put in place. The debt might have been kept outside of the structure at an individual level. We might have found a way to generate income sooner. Can't really deal with the depreciation. That's going to sit where the assets sit. But thinking ahead would have helped solve that problem or alleviate it to a large degree.
All right. So then moving on to investment structures. So what structures should we be thinking about when we're looking at investment structures?
So probably my first preliminary comment is that it's a really good principle of kind of asset protection and risk management that you keep your investment assets away from your business asset. So if you have a structure which you've used to run your business, and it's typically the structure that has risk, then when it comes to owning investment assets, you're trying to find a structure or an individual who's not at risk. You wouldn't put your new investment property inside the same structure that you use to run your business. That would just be poor planning, because if your business goes down, those assets are at risk. So what are the big options? Self-managed super, assets in your own name or in the name of a spouse or a family member who's in a less risky position than you. Alternatively, an investment structure like a trust, whether it's a unit trust or a discretionary trust, or even a corporate might be appropriate in some circumstances to act as your investment company.
And one of the things I think I should make sure I throw in here, because it can be confusing for people sometimes. If we're talking about say, for example, you have a family trust that is holding shares within for a company that runs a business or a practice or holds a practice, we're not talking here about there being an issue with that family trust that is simply holding the pure asset of the shares, then also being used to hold other assets, right? What we're particularly concerned about is not mixing the entities that have liability together with our pure asset holding entities. I guess that's that's sort of the distinction.
Yeah, the risk exists within the structure that is carrying on the business, not at the level of the passive owner of that business.
And, and that might seem obvious to us, but I think this is one of the things that I sometimes see they're not being full understanding of. So that's just why I thought I'd sort of point it out there. And I think it's a good point in relation to when you were talking about the personal name element. It's a really good point, because many people have this opportunity when they're buying their own personal home or whatever. Sometimes it can be useful to have a bit of a reflection on who is it in our family that is holding risk. Sometimes it's a good idea to make sure that that's not the person who's holding assets as well.
Yeah, absolutely.
Good. Okay. All right. So, and what's, I guess, an example of, some good models of investment structures that you've used, that you've seen work really well?
So at a personal level, buying assets in individuals' names, it can be useful to think about kind of if they're buying in real estate assets, for example, looking at assets in different states to utilise the land tax thresholds that exist, looking at who owns the asset, because each person will get their kind of access to those kind of thresholds. In terms of if you're running your business or practice through a discretionary trust and you actually are generating surplus income which you want to invest, but you don't want that income to have emerged from the family trust into an individual's name where it's taxed at a high tax rate, it is possible to set up a company which becomes the beneficiary of that trust and move the money from the practice trust across to the corporate beneficiary, only pay tax at the low company tax rate, and then invest the money inside the company.
Fabulous. Our bucket company.
Our traditional bucket company. There are disincentives to owning assets that grow in value inside companies, but everything's a trade-off in terms of tax now versus tax later.
It's about understanding that trade-off, obviously, isn't it? And taking the right advice. All right, and so then if we're talking about premises ownership, let's just have a really quick look at this as well, because that's another common strategy for practice owners to purchase their own premises, quite often in their self-managed super funds. So maybe run us through some positives and negatives in relation to premises ownership.
Sure. So again, there's a wide variety of options. Let's just talk about so they could be owned in individual names. You could own your practice premises inside a separate family trust, kept away from your practice. Or probably the one that gets most people interested is the self-managed super fund option.
Yeah.
Practice ownership inside a self-managed fund can have some real benefits. Obviously, the rental income will be taxed at the tax rate that the super fund's paying, 15%. The future capital gain on that premises will be a maximum of 10%, possibly zero, depending on the level of assets and where the person sits in terms of their pension position. There are some constraints. If there's going to be borrowing involved, then obviously you need to be working your way through the limited recourse borrowing arrangements that exist within super funds and the capacity of the fund to borrow itself. Rental needs to be at a market rate. One of the interesting things we see with multiple owners, so if I've got a group of dentists who are building a new premises and their ideal is to own that premises inside their super fund, but they don't have enough money inside their super fund to fund the whole development. So there's going to be some debt involved. It's not going to work if they each borrow within their super fund to buy their 1/4 share of the practice premises and do the build. It's just not the way the rules work. So a really good structure in that case is to set up a unit trust, which is the structure that goes out and borrows money and builds the new premises. And the units in that unit trust are owned by their super funds. So their super fund only puts in a small proportion of the money. The rest of it's funded by debt. But ultimately what will happen is that the debt will be repaid over time and the super fund will end up with quite a valuable interest in a unit trust which owns the premises. That's a really short explanation of what is a complex structure and needs to be understood. But there are ways around the fact that your super fund may not have enough assets in it at the moment to fund your premises. So it shouldn't just be ruled out because I haven't quite got to that point yet.
Absolutely fabulous. Okay, well, that's a really good tip. I like that one. Well, look, do you have any sort of general takeaways out of all of this that you think it's important to leave our audience with?
When your accountant talks to you about structures, don't let your eyes glaze over. It is important. What's important is to understand what the future holds for you and whether your both business and investment structures are kind of future-proof, whether they're flexible enough to cover what are the most likely options that you're going to see in the near kind of medium to long-term horizon. And do that regularly.
Do it regularly, plan in advance. Absolutely. I think really, really salient points there, Stephen. So, Stephen, if any of our listeners have a burning desire now to go and do that review of their structure, how can they find you?
Prosperity Advisors website or Prosperity Health will find my picture and a link to me and an email address. More than happy to have an initial discussion. Quite often what we do is we'll do an initial review and see if we can add some value and point out some problems and work out some solutions.
Absolutely fabulous. And have no fear if you are driving along on your way to or from your practice, or indeed if you're lucky enough to be running along on the beach while you're listening to this, don't worry. We've got Stephen's details in our show notes and on our website. Well, Stephen, I just want to say a very big thank you for coming on to Talking Law today. It's been great. I hope our audience's eyes haven't glazed over. I think we've kept it interesting. It's hard. Structuring isn't necessarily the most interesting topic, and yet it's so, so important.
Thank you very much for having me.
Well, that's it for our two-part series all about the top tips in business structuring for dentists and medical professionals with Stephen Guthrie from Prosperity Advisors. I hope you really enjoyed this two-part series. Maybe enjoy is too strong a word for when we're talking about structures, but I hope at least that you found it illuminating. If you'd like more information about this topic, then head over to our show notes where we link straight through to Stephen Guthrie at Prosperity Advisors, or head over to our website at talkinglaw.com.au, and through that website you'll be able to download a transcript of this podcast episode if you would just love to read it in more detail. And of course, on our website, you'll also find details of how to contact our legal eagles at Aspect Legal if you or any of your clients would like help with any of the items that we covered today, or indeed, if you have a business or a practice that is looking at exit at some point in the future, or indeed looking at acquisition for growth, and we can help guide you through these processes in the right way. Now, finally, if you enjoyed what you heard, I'd be ever so grateful if you could hit the subscribe button, and why don't you consider perhaps leaving us a review on your favourite podcast player. Well, that's it. Thanks again for listening in. You've been listening to Joanna Oakey and Talking Law, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. See you next time. Are you looking for a top quality legal team to assist you in your organisation? Aspect Legal is an innovative commercial legal practice that specialises in providing fast and professional services for their clients. If you'd like to chat about how we might be able to assist you, simply head over to our website at aspectlegal.com.au to book in a time for a free discussion with one of our lawyers.
Thanks for listening to Talking Law. Tune in next time for more smart legal tips and tricks to keep you clear of those legal landmines. If you want to get a download of today's show notes, head over to talkinglaw.com.au.
Are you looking for a top quality legal team to assist you in your organisation? Aspect Legal is an innovative commercial legal practice that specialises in providing fast and professional services for their clients. If you'd like to chat about how we might be able to assist you, simply head over to our website at aspectlegal.com.au to book in a time for a free discussion with one of our lawyers.